thank you to those that are joining the webinar today. Welcome to our webinar, Unlocking Tax-Free Benefits, the US-UK Tax Treaty, hosted by BlackPoint Capital Partners and Bright Tax. For today's call, we are joined by Nicholas Castillo with Bright Tax, Michael Jordan, Managing Partner at BlackPoint Capital Partners, and myself, Nicholas Mauricio, Managing Partner at BlackPoint Capital Partners. Before we get started today, a quick disclosure. The content presented is not tax, legal, or insurance investment or investment advice. It does not constitute an offer, solicitation, or recommendation for any investment products. Prospective investors should refer to formal offering materials for detailed terms, risks, and consideration before deciding to invest. And statements about financial market trends are based on current conditions and may change. Past performance is not indicative of future results.
Hello, everyone. For the benefit of those that are not clients as yet, BlackPoint Capital Partners is made up of a team of qualified holistic financial planners focused on providing comprehensive financial advice. The main areas that we cover are covered under our tailored financial planning services and risk management. The reason why this discussion matters today is primarily driven by the number of frequently asked questions that we have. Within the webinar, we're going to touch on industry opinions, your responsibility as a taxpayer, Bright Tax's position on the tax-free lump sum. The frequently asked questions that often resonate with myself or appear in the emails, etc., are, am I ready to retire? But am I retirement ready? How much will I retire on? Will my money run out? Which pot do I access first? In fact, the biggest one is often the how much would I be left with after taxes to fund my lifestyle? We believe a sequence of distribution plan is a must-have for all of our clients. Let's take a deeper look at a deeper dive in terms of how the PCLS or the Pension Commencement Lump Sum is often used. Nico?
Thank you, Michael. As we heard above, this is a very important tool in all of our clients' toolbox. Through efficient strategies, which we'll go over today, and thanks to the Bright Tax team, we'll understand how clients can typically, or some of the clients typically, access that 25% pension commencement lump sum, or PCLS. Some of the ways that clients or individuals do use this or utilize the PCLS is through, in order to reduce liabilities such as mortgages, contribute to investment accounts here in the US, increasing secure income ratio in retirement, education planning for their children or grandchildren, and finally to fund business ventures or endeavors here in the US. Everyone's position is unique and warrants conversation. So if there's any questions throughout the presentation today, please enter those into the chat box or send an email to your advisor or anybody and we can answer those questions towards the end of the presentation. So for today's presentation, next slide, Nick. So for today's presentation, I would like to introduce Nicholas Castillo from Bright Tax. Nicholas is from Miami, Florida. He's now a resident of Madrid, Spain. He joined the Bright Tax team in 2021 and has over 120 UK-based clients. He studied at the University of Miami and has a master's in taxation and is a regular contributor to the Bright Tax blog. Go ahead, Nicholas.
Awesome. Thanks, Nico. Hi, everyone. I'm Nicholas. You can call me Nick. I'm happy to be here talking to you guys about some really special and exciting things in the accounting world, which is a tax-free distribution in both the UK and the US. So first, we'll talk about an overview of the different pension tax laws in each country. We'll talk about the tax treaty in general, and then we'll get a little bit more specific as we go along. So let's talk about the pension laws themselves. So in the UK, there are a few types of pensions: the state pension, workplace pension, and personal pensions. The UK tax law allows an individual with a participating pension to take what's called a pension commencement lump sum, or PCLS, equal to 25% of the available balance at distribution. This is limited to £250,000, or a total pension amount of £1 million, at least right now, if they don't change the limits. The minimum age to start taking the distribution is 55 years old, also for now. The remaining 75% of the pension can be drawn down as pension income, and it would be subject to the individual tax rates in the UK at the time of withdrawal based on other sources of income in the UK at the time. Now, the US has a very particular stance on foreign pensions. In general, the US taxes its citizens and residents on worldwide income, which would include foreign pension income. Unfortunately, the IRS and the United States do not recognize the tax-preferred nature of many pensions. This means that your contribution to the pension would be considered taxable in the US, even if it is considered tax deferred in the foreign country. If the US then considers the foreign pension as taxable at contribution, then it does not consider the foreign pension taxable at distribution. There's only a tax on entry or exit from the pension account. The exception, of course, is appreciation in the account. So capital gains, dividends, interest should be taxable in the US upon distribution. The foreign tax authority will typically tax at distribution. So clearly there is a mismatch between when each government, each tax authority wants to subject the contribution or distribution to taxation. So to sort of mitigate this and to give some special considerations, the tax treaties that exist between certain countries cover pension. And a few examples of countries that have a treaty that benefit foreign pensions are the UK, Canada, and Australia. In our particular case, thankfully, the US and UK tax treaty does cover the PCLS. We'll get into that in a minute. Now, a little bit more on the tax treaties themselves. So, the tax treaty is a bilateral agreement between two countries to achieve certain outcomes, such as avoiding double taxation for the benefit of the taxpayer, and also to prevent tax evasion by creative accountants and individuals that are trying to avoid any taxation. Mainly to avoid double taxation, the tax treaties will specify which country has the right to tax which kind of income and how we can prevent that same income from being taxed by the other country. In terms of preventing tax evasion, these treaties include provisions to share information such as FBARs and FATCA reporting, which you may be familiar with, effectively to share information between governments and enforce proper reporting in all sides. So the treaties themselves are modeled by the Organization for Economic Cooperation and Development, the OECD, and their tax treaty. So this means that most of the tax treaties are very similar, with only small variations of the same common elements. Some of these include residency determination, whether you're considered more a resident of the US or more a resident of the UK, for example, for individuals that spend time in different, in both countries. Permanent establishment criteria, what makes you a resident based on your, where you have physical presence, treatment of certain types of income, withholding tax rates on dividends, interest, royalties. There's also capital gains, real estate transactions, multitude of other different types of income withholding rates, as well as procedures for resolving tiebreakers, for the example of an individual that lives kind of a split life between two different countries. And the most important one for this discussion is the savings clause. So the savings clause is a very interesting piece of the treaty. Now, what I want everyone to remember when thinking about this and seeing the savings clause is that this is an agreement between two countries and their tax authorities. When we talk about the savings clause, we're not talking about saving the taxpayer from taxation, from double taxation. We are talking about saving one foreign government from having to give up their right to tax certain income. And so this can effectively, so the savings clause can effectively negate a position that you take on certain articles, certain income, and basically eliminate the whole purpose of talking about this. So let's say the savings clause, it negates our relief from double taxation for a teachers and researchers grant in Article 22. The article might sound like it says that we have a tax benefit for individuals that are researching in another country, but the savings clause might say, okay, we're going to consider that still taxable because XYZ. They usually include a reason. So bottom line, what I'm trying to illustrate here is that it is complicated. And so what it really gets down to is that you may seem like you have a benefit from the treaty, but the IRS will reserve the right to tax that. Taxpayers need to have an idea of which part of the tax treaty the savings clause will affect and which is effectively negated, and which parts of the tax treaty are exempt from the savings clause. And of course, this can have a huge impact on how you plan your retirement, where you live, and where you invest. And so this savings clause exemption is the main reason why the UK lump sum, the PCLS, is considered tax-free in the US. So let's get down to it. The tax treaty between the UK and the US was introduced right after World War II to achieve the goals that I mentioned earlier. It was adjusted. It was subsequently developed in 1953 1975, 76, 1980, and ultimately what we have today is the 2001 version, which has been updated to include some more modern tax situations, to close certain loopholes that were present in the others, and to also fall more in line with the OECD model tax treaties. Yeah. So let's dial in to Article 17 of the UK-US tax treaty about pensions. So Article 17, paragraph 1, subparagraph B says that a pension established in one state, which for our purposes, the UK, would be tax exempt in the other state, for us, the US. So this means that if the UK effectively exempts the pension from taxation in the UK, then the US must reciprocate. Now, this paragraph, this subsection, is what I would consider, what I would refer to as the reciprocal section, because it is truly the, what one country does, the other country must reciprocate, must mirror. The second, actually, it's right after this paragraph in the article. The second important one for us is the 17 subparagraph 2. So specifically, so this article exempts a lump sum payment from a pension scheme established in a state, let's say the UK, and beneficially owned by a resident of another state, the US. And it seems like it is dialing straight into the lump sum issue, the PCLS. Now, the issue with this, and why it's a heavily debated section of the tax treaty, is that the savings clause will come in and negate the second clause that we were talking about, but it does not negate the first one. So let's put it like this. The savings clause is going to be effective and, let's say, ruin the tax treatment of based on Article 17, paragraph 2, which specifically talks about the lump sum payment. And so if you stop there, it sounds like it is over. But the savings clause does not affect the reciprocal section, or Article 17, paragraph 1, subparagraph B. It is our survivor from the savings clause, and that is how our position stands on its feet against the IRS, against audit, against any pushback, if it does come to that. So in other words, why do I say that about the IRS and the audits and pushback? If we were to take a position based on Article 17, paragraph 2, and say that the lump sum is not taxable in the US, the IRS can come back with a notice and say that, hey, nice try on the treaty position, but this Article 17, paragraph 2, we have a savings clause in that treaty, so we reserve the right to continue to tax you, and so that treaty position is nullified. Because we do not have that same issue, and Article 17, 1B, our reciprocal section, does survive, this will persist, this will survive in the face of the IRS. As they intended, the US did sign this agreement. So that is all good news for individuals in the US that are trying to take the PCLS tax-free in both the UK and the US. Now, this slide is just a little bit more of what I've already said. So it's showing that we really base our position on the 17(1)(b, that is the reciprocal section. Now, that's the theory. How do we put this into practice and make sure that you actually do the filing correctly and the IRS doesn't come sending you letters and knocking on your door? So any treaty position on your tax return is filed on Form 8833. So because we are using a treatment of income that is contrary to the IRS code and regs, which is what effectively governs the rest of the tax return, your 1040 and all those schedules that you see every April. Because we're going against those, let's call standard code and regs, and instead we're using this separate source of law, we are required to do a Form 8833 called the Treaty-Based Return Position Disclosure. And so this form has to be attached and included with your standard individual tax return, your Form 1040. It is due April 15 without extension. You can choose to extend your 1040 filing up to October 15, which it's important to note that that is a failure to, no, sorry, that is an extension to file. It is not an extension to pay. So if you have other income, you have other things you have to pay US tax on, then you still have to pay by April 15. Don't get that wrong. The failure to file will occur if you do not extend the tax return and you file after April 15, or maybe you file after October 15, and you effectively may lose the ability to claim your treaty position if that is the case. So why is it important to have professional support when preparing the treaty-based disclosure? It's not a very complex form. If you look it up, it's really a page long, but the instructions are long, and it is really important that you take the correct interpretation of the tax treaties and you explain it correctly so that we have no issues with the IRS accepting this, especially since there is the contentious savings clause that we have to be aware of. And so, of course, being the IRS, there are some anti-abuse measures that they implemented to prevent anyone taking advantage of these rules. So already we're in a really good situation, but if it's too good to be true, is it? Let's say you are a savvy individual and you're thinking that, you know, you already tax deferred all this money you put into a 401k or a traditional IRA, which is funded with pre-tax dollars, and you want to roll that up into a UK SIP or your UK pension, then you wait a little while, you distribute that 25% tax-free, and what happened? You avoided US tax on the pre-tax dollars, sorry, on the contribution, and you also avoid US tax on the distribution. The IRS has identified that that is a abusive position, and that if they do capture that and they do see that, they do penalize that, and they undo the tax position for the legitimate PCLS distribution. So like anything else, the tax treaty, it's there to serve its purpose, and any situation that is, we say, manufactured or created to abuse those laws and the spirit of the law, then the IRS has the right to strike that down. All right. So we like to say, get the tax returns right on the first try. So before making a big change to your tax situation or your retirement strategy, including the PCLS, please do make sure that you consult with a tax advisor, an investment advisor, and make sure that you have the right team in your corner. With Bright Tax, our team of dedicated tax experts can help you learn more about this. We can explain how this applies more to your situation and help you to claim the provision, the treaty position on your tax return in the year that you take this distribution. We also have a really awesome UK tax advisor that we work with, that together we can help you create a really comprehensive global tax strategy that really our idea is to optimize your global tax rate, make sure that you are not overpaying in any of the countries where you're liable to taxes.
Oh, perfect. If you had a direct question for either Nick and his team, the email address is there, hello@brighttax.com. Or for ourselves, BlackPoint Capital Partners, it's info@blackpointcp. That will come in. Any of us will get back to you with any answers, or we can obviously schedule some time to have a conversation and see exactly where we can point you in the right direction, and go from there. But thank you very much for that today, everybody, and we'll speak soon.